Click the bell icon to get latest videos from Ekeeda.
Hello friends. A company may be selling goods in Indian market as well as in foreign market, that is export market. In such case, the selling price in Indian market and in export market may be different. In such case, how to calculate the estimated working capital, that will be understanding in this question. Let us go through the question. MR Limited sells its goods in domestic, that is home market, as well as in foreign market, that is export market. Domestic selling price is determined at gross profit of 30% on sales, and export price is 5% below domestic price. That means export price is less and domestic price is more. Here they are saying 5% less. So if we assume domestic selling price 100 rupees, export price will be 95 rupees. These prices are without considering depreciation. Depreciation is a non-cash expense. So while calculating working capital, we are not required to consider it. Following are the estimated annual figures. Sales domestic, that is in Indian market, 12 lakhs. Sales in export market, 9,50,000. Material consumption per annum, 6,60,000. Wages, time lag 1 month, so current liability, full years 4,80,000. Manufacturing expenses, 1 month in arrears, current liability, excluding depreciation. But here they have given question mark. That means we are required to find out the amount of manufacturing expenses. This is another important point in this question, that they have not given the figure of manufacturing expenses, which we are required to find out. Administration expenses, half month in arrears. Again, it will be a part of current liability. Amount is given 1,20,000 per annum. Sales expenses payable quarterly in advance, the part of current asset. Amount is 60,000. Company's policy is to maintain 1 month stock each of raw material, that is current asset, and finished goods, which will be also current asset. Cash rupees 25,000. Domestic customers are allowed credit of 2 months, it will be part of current asset, and foreign customers get credit of 3 months from the date of sale. This will be also part of current asset. 2 months credit facility is available from suppliers of raw material. This will be part of current liability. Asset and the funds required as working capital on above estimates. Out of purchases of raw material, 10% are on cash basis. That means balance 90% will be on credit basis. Debtors are to be estimated at cost price and not at sale price. Ignore work in progress. That means there is no work in progress. Ignore work in progress. That means there is no work in progress. In this question, they have not given the per units detail. You can see there. Moreover, they have also not given the information of actual units produced and sold. They have given per annum values. With the help of this, we can calculate working capital. How to do this? Let us understand by preparing suitable working notes. Domestic selling price is determined at gross profit of 30% on sales and export price is 5% below domestic price. With this information, we'll try to find out cost of sales. Domestic sales is 12 lakhs, which includes profit 30% on sales. Domestic sales is 12 lakhs. Profit 30% of 12 lakh comes to 3 lakh 60,000. Sales minus profit 12 lakh minus 3 lakh 60,000. 8 lakh 40,000 is cost of sales. In case of export, they say that selling price is 5% below domestic price. So if domestic price is taken rupees 100, then price 100, profit 30, so 70 becomes cost of sales. Export price is 5% below domestic price. So your export price is 95. Domestic price is 100 less 5%, that is 5 rupees. Export price will be 95 rupees. So if export price is 95, cost of sales is going to remain same, that is what, 70 rupees. Then your profit margin will change accordingly. Export sales is 9,50,000. We can do your cross multiplication. If export price is 95, cost of sales is 70. So on a sale of 9,50,000, how much will be cost of sales? Do cross multiplication. So in case of export sales, cost of sales is 7 lakhs. In domestic, we have calculated 8,40,000. We'll add these two values. So 8,40,000 plus 7 lakhs, 15,40,000 is cost of sales, total cost of sales. This information we have calculated. Domestic sales minus gross profit, we got cost of sales for domestic market 8,40,000. Export price we have calculated as taking 5% less 95. We got here cost of sales 7 lakhs. Total it is 15,40,000. We are required to find out manufacturing expenses because that is a missing information. It will be based on cost of goods sold. We have information of material consumption per annum 6,60,000. We have information of wages 4,80,000. Material consumption per annum 6,60,000, wages 4,80,000, cost of goods sold we have just now calculated 15,40,000. So this will get as a balancing figure, manufacturing expenses. So we have calculated manufacturing expenses as balancing figure, that is rupees 4 lakhs. MR Limited, statement of estimated working capital. We have to start with first current assets, inventories, average stock of raw materials. Company's policy is to maintain 1 month of stock each of raw material and finished goods. So average stock of raw material 1 month. Raw material per annum divided by 12 to get for 1 month, multiplied by 1 month. Material consumption per annum 6,60,000 divided by 12 to get for 1 month, multiplied by period 1 month. So average stock of raw material we got 55,000. Cost of sales total we have 15,40,000. Cost of sales total we have 15,40,000. Average stock of finished goods for 1 month. Total cost per annum divided by 12 multiplied by period 1 month. 15,40,000 divided by 12. It's 1,28,333. Next, debtors. Here they have clearly given debtors are to be estimated at cost price. Domestic customers are allowed credit of 2 months and foreign customers get credit of 3 months from the date of sale. Cost of sales we have calculated in domestic market it is 8,40,000. In export market it is 7 lakhs. Eight lakh 40,000 divided by 12 multiplied by period it's 2 months. It is 1,40,000. In case of export, cost of sales is 7 lakhs divided by 12 multiplied by period 3 months. So debtors in case of export market 1,75,000. Sales expenses 60,000. Payable quarterly in advance. Sales expenses quarterly advance means period of 3 months. So sales expenses per annum divided by 12 multiplied by 3. Sales expenses per annum 60,000 divided by 12 to get for per month multiplied by 3 to get quarterly payment. So it will be 15,000. Here they have given it is company's policy to maintain cash rupees 25,000. So now we can have total current assets, that is gross. We can have total current assets, that is gross working capital 5,38,333. 2 months credit facility is available from suppliers of raw materials. This is information of current liability. Creditors for goods. Raw material per annum is 6,60,000 divided by 12 to get per month multiplied by period 2 months, therefore multiplied by 2. So it is 1,10,000. Wages time lag 1 month. Total wages paid 4,80,000 per annum. Wages per annum 4,80,000 divided by 12 multiplied by period 1 month. So it will be rupees 40,000. Manufacturing expenses 1 month in arrears. Manufacturing expenses we have calculated as a balancing figure, that is rupees 4 lakhs. So it is 33,333. Administration expenses half month in arrears per annum 1,20,000. So it will be rupees 5,000. Total current assets we have 5,38,333. From this we are required to deduct total current liabilities 1,88,333. So we got 3,50,000 as estimated net working capital. In this question, we have learned how to calculate net working capital when companies selling products in domestic as well as in export market at two different prices. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.